I'm David Gioricioni, Editor-in-Chief of Registered Rep Magazine. On Rep TV, we have Stan Luxenberg, a longtime Registered Rep contributing editor and mutual fund expert.
This has been a very tough year. Almost all the stock categories have been down. A lot of the top fund managers, whether it's Bill Miller, Bill Nygren, some of these people with strong long-term track records have had a terrible year. The financial stocks have been down. A lot of these funds have been killed. Some of the brighter spots, we've seen the long-short funds. Now, these are funds that can sell short, so they've done better. So funds like Schwab Hedged Equity, Aberdeen Long-Short, these funds have done better, and they will do better if stocks continue to go down. Now, the other thing that hasn't done too badly is bonds. Earlier in the year, municipal bonds got clobbered. A lot of hedge funds dumped them. They were doing different kinds of trades with municipal bonds. Since then, the muni prices have come back some, but there's still attractive yields on municipals. Now, high-yield municipals, like Pioneer High Yield Municipal Bond Fund, these funds are yielding 6%. That's a very good yield on that's the equivalent of a taxable bond that's paying more than 8%. And the defaults on municipals are still tiny. So this is a kind of interesting thing for retail clients to get some nice steady income and get the tax shelter. With municipal bonds, investment-grade municipal bonds always have tiny default rates, and the reason for that...
About what? So you're talking about...
You're talking much less than an annual rate, much less than 1%, a fraction of 1%. High-yield corporate bonds have average default rates of 4%, but munis are much, much smaller than that. Even in the unrated munis and the below investment-grade munis, they have low default rates. And the reason for that is that the issuers can... are municipalities generally, not always, but they're generally municipalities, and they can just raise taxes to pay for their bonds, or in some cases it might be a hospital that issues the bond, operations that have steady income. Now there can be defaults in below investment grade municipals and investment grade too, and you do see them in certain areas where what we've seen recently, there's been some defaults. There have been housing bonds where communities issue these bonds to support development of single-family homes. Some of these have defaulted, but these are tiny. Out of the thousands and thousands of municipals out there, very few defaults. Well, there's been a trend of investors putting more and more assets into foreign mutual funds. So about 25% of all equity mutual fund assets are in foreign funds. And a lot of this money has come in because we've seen in recent years there's been high returns. Latin America's delivered high returns. Even still this year, Latin American stocks have done pretty well. And of course you have China and India attracting attention, and Europe has done better than the United States. But all this has attracted people into international funds in recent years. Not in recent months, but in recent years there's been a movement into international investing. Now, some advisors say that if your client puts 10 or 25% into foreign equities, that's fine. But there are others now who are starting to say that you should put half your equity assets in foreign markets. And the reason for this is foreign equity markets are growing. They're accounting for a bigger percentage of the total market capitalization in the world. It used to be 10 years ago that most equity capitalization was in the United States. Over 50% was in the United States. But recently, as the equity markets overseas have grown, now most equity capitalization is overseas. So people who are pure indexers say that, okay, if 52% of world equity markets are overseas, you should have 52% of your equity portfolios overseas. I think that interesting ones are diversified growth funds. We have Julius Baer International Equity, Artisan International. These are focused on growth stocks and some of the opportunities in Eastern Europe and other places where there's still growth in the world. The other thing about some of these funds, I don't know if most investors want to have funds that specialize in the emerging markets. The emerging markets in Asia and some other areas have been a little rough lately. But if you get a diversified international fund that maybe has 5 or 10% of its assets overseas, say like William Blair International, it always has 10% or so of its assets in Latin America, Asia, the emerging markets of Eastern Europe. So this is, and then the other 90% would be in the developed markets of Europe and Japan. So this way you get blue chip European companies, but you also get some exposure to the emerging markets.